All right, welcome to another deep dive. You know how this works. You bring us the source material and we take the plunge together, really trying to extract the core ideas.
Yeah, and this time you've given us, well, a pretty significant book to wrestle with.
It is definitely foundational. We're talking Ludwig von Mises' The Theory of Money and Credit.
Not exactly light reading, but essential for anyone really wanting to understand money and, all the debates swirling around it.
Exactly. And we're diving into an edition that gives us even more to unpack. It's got the preface to this newer edition, plus Mises reflecting on the original 1924 German text, and even the preface to that second German edition.
So we've got historical context layered in.
We do, and that's part of what you want to explore, right? Not just what Mises said, but how it fits into the bigger picture of monetary theory and the whole history of money itself.
Right. I mean, understanding the evolution of ideas about money, especially from someone like Mises, can give us so many insights into, well, the system we're living with today.
And you're particularly keen on really getting those core principles, like how does money actually work? What's its relationship with the state? How does it impact the economy? And then, all those enduring questions around monetary
Yeah,
policy.
those are the big ones. Like, what are the real levers of control and who's pulling them?
Exactly. And that's our mission in this deep dive, to get you those aha moments, those flashes of insight, without making it feel like, well, you're stuck in some dry economics lecture. So, Mises, the theory of money and credit. Let's get into it.
All right, sounds good. Where do we start?
Well, I think it's fascinating how he really starts at the very beginning. Like, where does money even come from? How does it arise?
Right, right. He doesn't just assume it's always been there. He really takes us back to this, fundamental problem of barter.
Exactly. And he uses this really simple but powerful example. Imagine someone has, let's say, product P, and they want R, but the only person who has R will only trade it for P. You're stuck.
You're at a standstill. You need some kind of intermediary, something else, let's call it Q, that both parties are willing to accept.
Exactly. And that's essentially the birth of money right there, the emergence of this commonly desired good that can facilitate indirect exchange.
And what's so insightful about Mises' analysis is that he recognizes this isn't some top-down decree. It's not like someone just decided, this is money.
It's totally organic. It's this bottom-up process, this market-driven evolution where, as you said, those less marketable goods get weeded out. He even uses the phrase inevitable tendency for the less marketable to be one by one rejected.
Yeah, it's a beautiful illustration of spontaneous order in action. Individuals, in their pursuit of their own interests, are constantly seeking the most efficient means of exchange, and that leads to the emergence of money.
And he points out how as trade expanded, especially across geographically separated communities, you'd have different things serving as money in different places, which of course creates all sorts of issues.
Right, lots of friction in the system. It's like trying to fit together puzzle pieces that don't quite match.
A perfect analogy. So he suggests that it's really only with the possibility of a truly global marketplace that you get this real push towards a single, universally accepted medium of exchange.
Makes sense. And this all leads to his core point about the fundamental function of money. It's a lubricant for trade, plain and simple.
It makes transactions smoother, allows us to defer payments, the basis for credit and all that. But here's where it gets really interesting. He actually cautions against viewing payment as this completely separate legal act, independent of the ultimate goal.
Right, like it's not just some abstract legal game. Ultimately, all these exchanges, all the transactions using money, they're directed towards obtaining actual goods and services for consumption.
It all comes back to wanting to use and enjoy those things. Money is just the tool that makes that whole process much, much easier.
Exactly. And that brings us to another key insight from Mises, which is all about what money isn't.
And this really struck me too. He takes aim at this idea of money as a direct measure of value, which he calls a fallacious notion, especially considering, well, the whole subjective theory of value.
Which is, of course, central to Mises's whole economic framework. So value isn't some objective quality inherent in things.
It's all in the eye of the beholder, right? Like what's valuable to me might be worthless to you.
Exactly. Value emerges from those subjective preferences, from the exchange ratios that individuals establish in the market.
So money, according to Mises, isn't some objective yardstick for measuring that inherent value. It's more like a reflection of those already existing exchange relationships.
It's a representation of that constantly shifting interplay of supply and demand. It doesn't embody some, intrinsic quantifiable value of goods and services.
Which has huge implications for how we think about prices, and, how we even approach monetary policy.
Absolutely. It challenges this idea that you can simply manipulate the money supply and directly control prices in some precise way.
Right, because those prices are ultimately reflections of those subjective valuations, not just some mechanical output of the amount of money in circulation.
It's a much more complex and dynamic system than that.
Now, he also makes a point of saying that money isn't a production good,
Right. It's not something you directly use to make other things like tools or raw materials.
and it's not a consumption good either.
No, it doesn't directly satisfy our wants in the way that, say, food or shelter do.
It's really more about facilitating the acquisition of those things. It's a means to an end, not an end in itself.
It's a tool, a very powerful tool.
And a tool that becomes part of someone's private capital, according to Mises, only when it's actively being used to obtain other capital goods, the things that actually are used in production.
So your idle cash, the money just sitting in your wallet or, stashed under your mattress, it's not really functioning as capital in this economic sense.
Interesting distinction. And it's important to differentiate this from the broader concept of social capital, which encompasses things like, networks of relationships, institutions, all those things that kind of grease the wheels of economic activity.
Yeah, it's a much broader concept. And speaking of historical context, it's fascinating how Mises brings up the whole doctrine of the sterility of money, this old idea that money can't inherently produce more money.
Right, and how that played into early ideas about interest and usury.
Like for a long time, charging interest was seen as, well, kind of immoral. This whole idea that money itself was barren reinforced that view.
Because if money can't breed more money, then charging someone for using it seems, inherently unfair.
Exactly. It wasn't until economic thinking really started to grapple with the concepts of the time value of money, the role of capital in production, that those old perspectives started to shift.
Makes sense. Now let's get into the different types of money that Mises lays out, because he gives us this really helpful categorization.
Yeah, he breaks it down into three main types: commodity money, fiat money, and credit money.
So let's walk through those one by one. Commodity money, that's probably the most intuitive to grasp.
Right, it's something like gold or silver, where the value of the money is directly tied to its value as a raw material. Like gold has intrinsic value because it's used in jewelry, electronics, various industrial applications. So gold coins, they're literally worth their weight in gold.
Makes sense. Fiat money, on the other hand, that's where things get a bit more abstract, right?
Yeah, fiat money derives its value not from the material it's made of, but from the decree or stamp of the state.
It's like the government just says, this piece of paper is worth something. And because we all trust, or at least mostly trust, the government backing it, we collectively accept it as payment.
Exactly. Think of the banknotes we use today. The paper itself is essentially worthless. It's the government's backing, and that shared belief that it represents something of value that gives it purchasing power.
And then there's credit money.
Right. Credit money is essentially a claim to a future payment that circulates as a medium of exchange. It represents a promise to pay a specific amount of money at some point in the future.
Like an IOU that can be used as money.
In a way, yes. Though Mises distinguishes between money substitutes, which are claims to money that are fully backed by reserves, and fiduciary media, which are claims to money issued in excess of those reserves.
So like a check I write, assuming I have the money in my account to cover it, that would be a money substitute.
Exactly. It's a claim to money that can be readily redeemed. But if banks start issuing more claims than they have actual money to back them up, that's where you get fiduciary media.
Which is, of course, the foundation of fractional reserve banking.
Precisely. And that gets into a whole set of dynamics that we can explore later. But going back to the role of the state, historically, governments definitely played a role in, well, at least with commodity money, ensuring its reliability.
Right, like minting coins, certifying their weight and purity, and declaring them legal tender.
Yeah, the state's initial involvement was largely about facilitating trade by, ensuring trust in the metallic money being used. However, and this is a crucial point that Mises makes, the state can't just arbitrarily declare something to be money and expect it to work.
Right, it's not that simple.
No. He emphasizes that it's ultimately the common practice of all those who have dealings in the market that establishes something as money.
So, market acceptance is key, regardless of what the government tries to impose.
Exactly. It's not about decrees, it's about people actually using it as a medium of exchange in their day-to-day transactions.
So even when governments try to shift from one monetary standard to another, Like, for example, when Germany moved to the gold standard, it wasn't just a matter of passing a law.
Right. They had to actually go through the process of exchanging the old forms of money for the new.
And when the state creates fiat money or credit money, Mises argues they typically build upon existing money substitutes that are already circulating.
Yeah, they take these existing claims and basically declare them to be the new official money. It's an interesting process of evolution and adaptation.
Okay, let's try to tackle something that's always been a bit mind-bending for me, this whole idea of index numbers and how they relate to the value of money.
Yeah, this can get a little complex.
Because, as I understand it, these index numbers are attempts to measure changes in the objective exchange value of money, right?
Yeah.
Like how much has the purchasing power of money changed over time?
That's the basic idea, but Mises is quite skeptical about how useful these index numbers really are for monetary theory.
And why is that? What's the core of his argument there?
Well, his main point is that these index numbers rely on this assumption that some goods have a constant objective exchange value over time.
Which, in a dynamic economy where things are always changing,
He argues is inconceivable. Like, think about it. Supply and demand for all goods and services are constantly shifting. New products are being introduced. Old ones are becoming obsolete. So to find a stable benchmark to measure the value of money against, it's pretty much impossible.
it's like trying to hit a moving target with another moving target.
Exactly. And because value is ultimately subjective, any attempt to objectively measure money's purchasing power is going to be inherently flawed.
So even these complex calculations, they're not really capturing the full picture.
Not really. They're always going to be a simplification of a much more complex reality. Even the economists who developed these statistical methods recognized their limitations.
So trying to come up with some average that accurately reflects changes in the overall value of money, it's inherently problematic.
Yes, because the underlying values themselves are always in flux. It's like trying to measure the average temperature of a room when the temperature at every point is constantly changing.
That's a great analogy. Now, let's move from the theoretical to the more, real-world effects. What about the social consequences of changes in the value of money? Because Mises emphasizes that these changes don't ripple through the economy instantaneously or uniformly.
Right. He points out that when, say, the money supply increases, it enters the economy at specific points and impacts certain people first.
So it's not like everyone suddenly has more money in their pockets.
No. It starts with the initial recipients of that new money, and then it gradually spreads, but it affects income distribution in a very uneven way.
So those who get the new money first, they benefit because they can spend it at the old prices before things have had a chance to adjust.
Exactly. But as that new money works its way through the system, prices start to rise. So those who receive it later, they face higher prices, but haven't necessarily seen a corresponding increase in their own incomes.
Which really challenges this common idea that just increasing the money supply is automatically good for everyone, right? Like, if we keep hearing that it's good for the economy, where does Mises' analysis diverge from that conventional wisdom?
Well, Mises would argue that while some might see rising prices and wages as a sign of economic growth, it can often be a bit of an illusion, a consequence of the currency being debased. Continually depreciating the value of money can lead to all sorts of distortions in the economy.
Like what? What are some of those specific distortions?
Well, for one thing, people start trying to get rid of their cash as quickly as possible, fearing that it's going to lose even more purchasing power.
Makes sense. You don't want to be holding something that's constantly losing value.
Exactly. And this rush to spend can lead to a breakdown in the use of that currency, which Mises refers to as demonetization.
And it can also distort economic signals, right? Like, it becomes harder to tell which investments are actually sound and which are just being driven by, this inflationary pressure.
Absolutely. It can lead to malinvestment, where resources are poured into projects that wouldn't be viable in a stable monetary environment.
Now, on the other hand, he also discusses the less popular scenario of increasing the value of money, deflation. And while on the surface, that might seem like a good thing, hey, your money buys more, it also has consequences.
Right, especially for borrowers who now have to repay their debts with currency that has become more valuable.
Ouch, that's gotta hurt.
It can. And historically, policies that seem to favor creditors over debtors haven't been very popular, to say the least.
Makes sense. Now, all of this leads us to the whole realm of monetary policy, the attempts by central banks and governments to, manage the value of money, influence the money supply, control interest rates, all of that. Given all these complexities and the potential for unintended consequences, Mises seems, pretty wary of the ability to actually control all this effectively.
He is. He highlights the inherent difficulties and uncertainties in trying to fine-tune the exchange value of money through intervention.
It's not as simple as, turning a dial and getting the exact outcome you want.
Not at all. And he points out that these interventions often reignite those conflicts between groups who favor different monetary policies.
Right, like the battle between the inflationists and the deflationists.
Exactly. And he also points out that those terms, inflation and deflation, they become really politically charged.
Because they represent different interests and ideologies.
Right. And once they're defined by specific degrees of change, they become less useful as analytical tools for pure economic theory. Like, is a 2% increase in prices inflation? What about 5%, 10%? It gets messy.
It does. Now, one of Mises' really strong arguments is that the value of money isn't determined by the overall wealth or productivity of a country.
Right. He says it's about the relationship between the total quantity of money in circulation and the demand for holding that money.
So a country can be incredibly productive, but if it mismanages its money supply, you can still end up with a worthless currency.
Exactly. And he uses the dramatic examples of the German and Polish hyperinflations to illustrate this point.
Those are some pretty extreme examples, but they really drive home the point, don't they?
They do. They serve as stark reminders that even highly productive economies can experience these catastrophic currency collapses if the supply of money is completely out of control.
And conversely, you can have less wealthy nations that maintain stable currencies because they have sound monetary principles in place.
Precisely. It's not about how much wealth a country has, it's about how it manages its money.
Now, Mises is also quite critical of government-imposed price controls and wage controls.
Yes. He argues that they ultimately undermine the functioning of a market economy.
Because they interfere with those price signals that are essential for guiding economic decisions.
Right. Those prices convey information about supply and demand. When you try to artificially suppress prices, you inevitably create shortages and distortions.
Yeah, and then you often end up with black markets and all sorts of other unintended consequences.
Exactly. And he argues that those attempts to control prices can actually pave the way for a centrally planned system.
Because the government has to keep intervening more and more to try to manage the consequences of those initial interventions.
It creates this vicious cycle. He points to the economic policies implemented during wartime as examples of this kind of creeping central planning.
And he also correctly points out that exchange rates between different currencies are fundamentally determined by their relative purchasing power in their respective economies.
That's the idea of purchasing power parity. It's this underlying force that drives exchange rates.
Okay, let's dive into an area that's really central to Mises' analysis. Fiduciary media and the banking system. This is where the creation of credit and its impact on the money supply becomes really important. Can you clarify the distinction he draws between money substitutes and fiduciary media?
Sure. So money substitutes are essentially claims to money that are fully backed by reserves. Think of it like a warehouse receipt for actual money, like a gold certificate that represents a specific amount of gold stored in a vault.
Okay, so it's like a one-to-one relationship. Each claim can be redeemed immediately for the actual money it represents.
Right. It's a direct representation of actual money held somewhere else. But fiduciary media, while they're also claims to money like banknotes or checkable deposits, they're issued in excess of the underlying reserves.
So it's like there's more claims circulating than there is actual money to back them up.
Exactly. Think of it like this. A money substitute is like a fully funded gift card. You have a card that represents a specific amount of money that's already been set aside.
Makes sense.
But fiduciary media, it's more like an overdraft facility on your bank account. It represents a claim that goes beyond the currently available funds.
Okay, I'm starting to see the distinction. So when a bank makes a loan and credits the borrower's account with a new deposit, that new deposit, to the extent it's not backed by existing reserves, that's fiduciary media.
Exactly. It's a claim to money that doesn't have a corresponding amount of actual money sitting in a vault somewhere waiting to be redeemed.
Which is why it's so important that not everyone tries to redeem their claims at the same time, right?
Exactly. That's the inherent risk with fractional reserve banking. But Mises also points out that, legally speaking, accepting a deposit withdrawable on demand, it might be classified as a kind of credit transaction. But economically, he argues, it's fundamentally different from lending a tangible good, like a tool or a piece of machinery, and expecting it to be returned later.
Because with a bank deposit, you still retain the right to withdraw those funds immediately.
Right. It's a different type of obligation. Now, he also explains how these clearing systems within the banking industry, they help to reduce the overall demand for physical currency.
Right, because banks can kind of net out their obligations to each other.
Exactly. Clearing houses and those mechanisms for canceling out debts between banks, they allow for a huge volume of payments to be settled without the need to physically transfer cash or even those fully backed money substitutes. It just makes the whole payment system more efficient.
Makes sense. So how do banks, through their lending practices and their decisions about interest rates, how do they actually influence the circulation of these fiduciary media and potentially impact the overall value of money?
Well, a single bank acting alone, it has limited ability to really expand the amount of fiduciary media out there.
Because they have to worry about other banks calling on them to settle up, right?
Exactly. They need to maintain those clearing balances. But if you have a large number of banks, all acting in a similar way, collectively expanding credit and issuing more of those fiduciary media, then the overall money supply can increase significantly. And that can lead to a decrease in the value of money or, inflation.
So that's the core mechanism through which credit expansion can contribute to inflation.
Exactly.
Now, Mises also addresses this idea of the elasticity of fiduciary media, this argument that the banking system can, readily adjust the supply of credit to meet the demands of businesses.
Right, like the banks are just responding to the needs of the economy. But Mises points out that this view overlooks the fact that banks can also actively stimulate demand for credit.
By lowering interest rates or by easing their lending standards.
Exactly. And if you have a lot of banks doing this at the same time, you can get this persistent expansion of fiduciary media, which can drive down the purchasing power of money.
So the argument that banks are just passively responding to demand, it's not the whole picture.
No, they can be active players in this process. And this gets to the whole concept of redemption, which is absolutely crucial for maintaining the value of these money substitutes and fiduciary media.
Right, this ability to convert them back into base money, to actually get your hands on the underlying real money.
Exactly. As long as people have confidence that they can readily redeem those claims, those fiduciary media can circulate without everyone constantly demanding that redemption.
That's the foundation of fractional reserve banking.
It is. But, Mises also briefly mentions some of the pre-war debates about banking regulation, like Peel's Act in Britain, and some of those efforts to keep interest rates artificially low, which he thought might undermine this obligation of cash redemption.
Because if interest rates are too low, it encourages excessive borrowing and lending, which could lead to a situation where there's not enough real money to back up all those claims.
Precisely. It can create this imbalance. And he also touches on the gold exchange standard as this post-World War I policy aimed at trying to restore some stability after all that wartime inflation.
Which really highlights this ongoing challenge of how to manage fiduciary media, how to maintain that obligation of redemption while also dealing with the pressures to expand credit and stimulate the economy.
It's a balancing act for sure.
It is. Now, all this leads us to the gold standard, which Mises was clearly a strong advocate for, and the criticisms that have been leveled against it.
Right. He presents the gold standard as embodying this sound money principle that was so central to 19th century classical liberalism and the idea of a free market economy.
And for Mises, that gold standard, it served as a really important constraint on the ability of governments to just inflate their currencies at will.
It was an anchor that prevented those arbitrary and potentially really damaging monetary policy decisions.
Because if you're tied to gold, you can't just print more money whenever you feel like it. You have to actually have the gold reserves to back it up.
Exactly. And Mises argues that the gold standard didn't collapse because of inherent flaws. It was actively dismantled by governments because they wanted to create the conditions for inflationary policies.
Because those inflationary policies allow them to, finance their spending without having to raise taxes or cut other programs.
Right. It gives them more flexibility, but at the cost of potentially undermining the value of the currency.
Now, Mises also addresses this argument, the full employment doctrine, which is sometimes used to justify inflationary policies.
Yeah, the idea that a little bit of inflation can stimulate the economy and reduce unemployment.
And he acknowledges that some people who understand the long-term negative consequences of inflation, they still might advocate for it in these emergency situations.
Right, like they see it as a necessary evil to deal with a specific crisis. But Mises warns against this kind of thinking. He's very concerned about the slippery slope of using inflation as a quick fix.
Because it can easily become a habit, right? And those long-term consequences, they eventually catch up with you.
Exactly. And he also points out that inflation can be a very useful tool for those who advocate for greater government control over the economy.
Because it allows them to expand their influence and intervene in more and more areas.
Yes. And he argues that it can be used to finance reckless spending and then create a pretext for imposing even more price controls and other forms of economic planning.
So it's not just an economic issue, it's a political issue as well.
Absolutely.
Yeah.
It gets right to the heart of the role of government in the economy.
Now, he even uses a hypothetical example, the nation of Ruritania, to illustrate the principles of how you would go about reforming a currency.
Right. He emphasizes the importance of ending inflation and then ensuring convertibility to some stable base like gold, or at least to a currency that's considered stable.
So you need to establish that anchor to regain trust in the monetary system.
Exactly. And then he gets into this debate between the restorers and the stabilizers about the appropriate exchange rate to use when you're trying to go back to a gold standard after a period of depreciation.
So that's a debate that continues to this day, right? Like,
Right.
what's the right exchange rate to peg your currency to?
It does. It gets to the question of, do you try to go back to the old parity, or do you acknowledge the reality of the depreciation that's already happened?
It's a tough question. Now, finally, Mises offers some critiques of alternative monetary theories that were popular in his time.
Yeah, he briefly takes on Schumpeter's theory of money.
And his main issue seems to be with what he considers to be an arbitrary division of the supply and demand for money.
Right. He doesn't find it to be a particularly convincing or useful way to think about money.
And then he really goes after the nominalist school of thought, especially Knapp's state theory of money.
Yeah, he's quite critical of that. He sees it as dismissing economic theories of value and focusing solely on the legal definition of money as something created by the state.
Because for Mises, it's all about that economic function of money. Right. It's about the market. It's about people choosing to use something as a medium of exchange.
Exactly. And he thinks that nominalism fundamentally misunderstands the forces that actually give rise to money and sustain its value.
And he even takes a moment to point out the difficulties in translating some of these German economic terms into English.
Right, like trying to find the precise equivalent for the term Umlaufsmittel, which ultimately led to the adoption of fiduciary media as the most accurate translation.
Which really shows his attention to detail and precision.
It does. He wants to make sure that his ideas are being communicated clearly and accurately.
Well, I think we've done a pretty good job of unpacking those ideas. This has been a seriously comprehensive deep dive into Ludwig von Mises' The Theory of Money and Credit. We've covered a lot of ground, from the very origins of money to the different types of money, to the state's role, the complexities of measuring its value, those social impacts of its fluctuations, the challenges of monetary policy, the workings of those fiduciary media and the banking system, the principles of the gold standard, and even his critiques of those alternative perspectives. It's been a journey.
It has. And, it really strikes me that even though he was writing back in the 1920s, so much of what he said is still incredibly relevant today.
Oh, absolutely. The global financial system has obviously evolved a lot since then, but those core economic principles that he articulated, they still provide this really powerful lens through which to analyze contemporary monetary issues.
Like we're still wrestling with those same questions about inflation, deflation, the role of central banks, all of it.
Exactly. So for you, the listener, as you're watching all this unfold in the world today, all these debates about, digital currencies and monetary policy, think about the insights that Mises offers. Like, what assumptions about money do you find yourself questioning now? What new perspectives has this deep dive given you? That's something to really ponder. Thanks for joining us.
And thanks for bringing us this challenging and thought-provoking book. Always enjoy these deep dives.